Hello, everybody. Welcome to another geopolitical analysis video. This is an ad hoc video. I just, after yesterday with the rise in interest rates, I decided to do this right now. Um, Over the past year and a half, 2 years, we've seen the rise of so called interest rates. Now, a lot of analysts, a lot of economists will mention that this is the best thing that we can do to fight inflation. Yet we are disillusioned thinking that because of the amount of printing, all this printing, QE that we hear, right? And for the layman, for the average person, to us we just think that there's just printing money, giving money to everybody. The reality is that the Federal Reserve has reserves, okay? And those reserves coming handy for certain stress situations and for fixing their own balance sheet. Now, of course, there are things that go on outside of the balance sheet that we can see. But the reality here is that this inflation, like we've said time and time again, is not based on necessarily the Fed inflating, right? This is also outside of the purview, the regulation of the Fed, which is the euro-dollar system, which has over leveraged, right, the system and people, because they're counterparties that have agreements and trusted and trustees. They lend with insane amount of leverage, and that's outside of the Fed. So at a point where now, because you hear, the Volcker era of the 70s, the Volcker who raised interest rates to 20% and at some point defeated inflation. That can only happen when your debt to GDP ratio is 1 to 1, 1 to 2. Our debt to GDP is like 4 times. Here in North America, namely the US, we created a system which is debt based, meaning it only works with low interest rates when money is cheap and is affordable. It does not work when we have this credit contraction, when we have this reduction of credit supply. Because what's going to happen with the small, medium sized businesses? Sure, the larger enterprises, the cash cows will survive, but we're creating a self induced coma, a self induced recession that the Federal Reserve is creating by raising these interest rates. And it's such an anomaly, too high. You can contract your balance sheet, but when the M2 supply, the money supply, is going down and you're raising the bar of the cost of essentially the price of your debt, that becomes unbearable. And we will see in many different markets, and we've already seen a rapid slowdown, right? Now, talking about the banking contagion, we are going to see lots of other regionals, I believe. And this is all happening because people are pulling their money out of the banks and they're putting them in market funds in areas where they can get that 5% back. Whereas a bank is going to give you the minimum. And a lot of them are selling stocks, selling equities, and putting their money in a safe 5% to wait and see what goes on and what takes place here in the coming months. Now, what we should be doing as retailers, we need to not get suckered into this whole Wall Street mentality of buy the dip in stocks, buy the dip. It's lower, it's cheaper. That's how you lose money, and that's how you miss these opportunities. I've been short for months now the market, and I've profited handsomely. I've had moments where, yes, I sold, I went long, because everything comes down in waves. It's never one straight line. So when I look at the Fed and I understand now the macro, the Fed is trying to like is fixated on a small gear in the system, albeit a very powerful gear, but it's not looking outside of the Fed, right? And that's the thing when you have mercantilist nations like China, possibly the Brazil, possibly Saudis, all these countries who are producers and who have benefited because of the American system, the American dollar, they are turning on the US, right? Because they're seeing the weakness there and they're taking advantage of this whole notion of pushing back to this fiat Ponzi. But I'll tell you something. These mercantilist nations who are looking at their closed economy, they will suffer the most because historically, no mercantilist country endured recessions, inflation, could not endure because we are fundamentally, structurally a globalized system. We are not regionals and small local markets anymore. And because our entire system has been based like that, when you go against that, you suffer the most. And the US also has accepted liquidity from so many countries who parked their money and bought treasuries. Okay. So that also is inflationary. All I'm saying here is that we're going to go through a rough patch. And if we continue like this, I believe that the Fed might purposely want to centralize banks, create smaller and smaller banks. Okay. Some time ago, there were 10,000 banks. You might ask why? It's because every region is different and we need different types of loans. That's why you have different types of banks. But a bank is like a hedge fund. It needs to make money and protect itself against certain situations. That's why they have a large risk management department. I've been in the situation where I worked with banks. I had to sell different applications, and banks are not agile. They are not agile, and most often than not, they see the review mirror, the rear mirror, and not forwardly. So they're not prepared for many things that happen. So, rule number one: cash is the best thing right now to hold, if not long-term treasuries. And one thing that we need to make sure of is be prepared because we might be in a situation where, yes, there will be a recession, things will get cheaper, but inflation might be stubbornly high for a little bit. Those are my 2 cents. That's what I wanted to say. I support gold, I support Bitcoin, and it might be good to just hold cash and wait a while until we see what happens with the markets. We don't always have to be invested in something. Sometimes it's good to hold back, take the gains, peruse, and then jump in when the water is better. Thanks so much. Bye for now.